Well, hey, welcome back. Today we're going to take a look at, should I pay off my investment property? Now, there's a lot of conflicting information out there about whether or not it makes sense to pay off your investment properties or to keep them highly leveraged. There's all sorts of people that have opinions one way or the other. So in today's video, we are going to take a look at the pros and the cons of each thing, of having your investment properties completely free and clear versus having them leveraged with mortgages on them. So if you're interested in that, that's what we're talking about today. All right, so first things first, let's talk about the advantages of paying off your investment property. So let's say you've got 1, 2, 3, 4, 5 rentals, whatever it is. What are the big advantages of having them free and clear without a bank mortgage on them? Well, the first big advantage is full ownership. I mean, if you've got a free and clear property, you are the bank. You don't have to deal with mortgages, renewals, fluctuating interest rates, none of that stuff. Your property is free and clear. And the biggest advantage to that is how that affects your cash flow. I mean, think about it. If you've got a rental property right now and you're renting it out for, let's say for easy numbers, $2,000 a month, but your mortgage payment, your property taxes, your insurance, all of that stuff comes to $1,900 a month, then your cash flow is only $100 a month. On the other hand, let's say you've got that property free and clear and your mortgage used to be $1,100 a month, and now all you got to worry about are the property taxes, insurance, and maintenance fees, and let's say that comes into $300, $400 a month. Now you are cash flowing $1,600 a month on that same property. That makes a huge difference on your bottom line month to month to month. That's the kind of money that really creates financial freedom. It's very, very hard to create financial freedom with $150, $25 a month cash flow per property. But if you're getting $1,500, $1,600, that's starting to make a big difference. Another big advantage having your property paid off free and clear is it lowers your risk. I mean, think about it. Just recently, we've seen a big spike in interest rates. People got nice and cozy and comfortable with 1.5%, 2% ridiculously low interest rates from the bank, and they started to think that that was normal. And they were leveraged up the yin-yang, and then that turned around, and those interest rates went up to 4%, 5%, 6%, 7%, etc. Well, that made a huge difference on a lot of people's real estate investing portfolios. I mean, a lot of people went from barely scraping by or a little bit cash flow positive to now they're massively in the red. They're massively negative cash flow on those kind of properties. Now think about it. If you're free and clear, that eliminates that pressure. That eliminates that risk. So you don't have to worry about the bank foreclosing on you because you don't owe them any money. It's free and clear. If the property goes vacant for a month, not a big deal, right? You've got very minimal expenses going out on that property. So if you're looking for a much lower risk type of investment, having a free and clear property is definitely the way to go. All right, now the third big advantage kind of ties into the last one, lowering your risk. It's peace of mind. If you've got a free and clear property, it's a huge financial burden off of your shoulders. It's a huge relief. It's something that you don't have to think about. It's something that you don't have to worry about. It's a way that you can sleep a lot more securely at night because you don't have to worry about mortgage rates changing, the bank having to refinance with the bank, any of that stuff. You've got the property free and clear. So if you're looking for peace of mind, that's definitely something you should look at. Now, all of this reminds me of a good friend of mine, Ken. And Ken was a very active real estate investor for many years, built up a small multifamily portfolio, not that small actually. I think at the peak he had close to 200 rental units, which sounds very impressive. But Ken was following along with what all the gurus say, which was keep your mortgages pretty high, keep them pretty highly leveraged, and then that way you're able to go and buy more properties, and also you're kind of reducing your risk, you're reducing your exposure because you don't have a lot of equity in these properties, so there's not a lot of risk of people suing you trying to get the equity out of these properties. So that made a lot of sense, but at the end of the day, if you've got 200 rental units that are only cash flowing you 10, 15, $50 a month, that's not a lot of return on your investment. That's not a lot of cash flow to work with month in, month out to replace your JOB income. So what Ken has started doing is he has started to really consolidate his portfolio. He sold off all the dogs. Actually, I believe he sold off all of his properties, and he built a brand new multifamily from the ground up. And then what he's doing, what he and his wife are doing, is really, really focusing their efforts on paying off having that one property and getting it free and clear within the next 5 years. And once that property is free and clear, it's going to be a cash cow. It's pretty much brand new, so very, very little maintenance is going to be required on it. It's bringing in the top quality tenants because it's a brand new property, so they're getting top quality tenants and top rents for it. It's a real win-win scenario for him. And he's got things structured so he's minimized his exposure as far as people trying to come after him and sue him and access his capital that way. So it's a real, you know, the older these folks are getting, the more they're focusing on just having that peace of mind and that cash flow to replace their incomes. So makes a lot of sense in his case. All right, so those are the pros, or the major pros of having a free and clear investment property. What are some of the disadvantages? Well, let's take a look at that right now. So I guess the biggest disadvantage potentially is lost opportunity or opportunity costs. What does that mean? That means if you've got $1 million property and you don't have a mortgage on it, and you've got that all of your wealth is tied up in that property, then how are you going to be able to go out and buy another property? You have everything, all of your eggs are in that one basket. So you might miss out on really good deals that you could have got into if you had some cash on hand. So opportunity cost is probably the biggest downfall to having your properties paid off and free and clear. Second disadvantage is lack of diversification. If you've got all those eggs in that one basket, and let's say an emergency comes up and you need to sell quickly, well, you know, especially if you're in a multifamily space, it doesn't always happen super fast. Even single family homes doesn't always happen exactly when you want it to. So by having all of your capital tied up in your property, you're not very well diversified, and you're at a little bit of risk that way if you need to access the cash quickly. Third disadvantage is lower cash on cash returns. Well, Dave, what are you talking about? You just mentioned that if you had your property free and clear, you'd be getting all of the cash flow from that property. That would be all beautiful passive income coming into your pocket every single month. What do you mean you're getting lower returns? Well, what I mean is you're getting lower cash on cash returns. So for example, let's say for easy number, we're talking about $1 million property. Well, if you've got that $1 million property and you're cash flowing, I don't know what it would be on that, but let's say for simplicity's sake, let's say it's $25,000 a year. Might probably more than that, but let's say it's $25,000 a year. Well, you're getting $25,000 return on investment on your $1 million investment, okay? Now, let's say you had that same property, and somehow, don't quote me on the math here, but just follow along. Let's say that property was cash flowing $10,000 a year, but you had an $800,000 mortgage on it. You'd be getting $10,000 on your $200,000 equity, which would be a much higher cash on cash return than the other option we were looking at. So again, it's all about that. Plus, if you got it paid off, if you got your property paid off, there are certain write-offs and deductions that you don't get to take. So for example, you can't write off your interest because you're not paying any interest. You don't have a mortgage, you don't have a loan on the property. So those are some of the pitfalls to having your property free and clear. So at the end of the day, whether you want to pay off your property or not really depends on what your long-term goals are and what your comfort level is. So for example, myself and my wife were really, really focused on paying off our primary residence and our secondary residence. So we want to get those, you know, our personal properties paid off as quickly as possible. But myself, on the long-term investment side, I'm happy to have those properties fairly highly leveraged until I build up the portfolio to the extent that I want to consolidate it, kind of like my buddy Ken, and then really just create that massive cash flow as the retirement fund. So you're able to scale up faster and go bigger if you don't have all your eggs in the one baskets. You can do more deals and grow that portfolio. But once you're ready to kind of sit back and relax a bit, then it's probably a better idea to have fewer properties that are cash flowing more. All right, so either way, if you're looking to leverage your properties or get them paid off, if you want to have more of them, chances are you're going to have to tap into other people's money. And I got a solution for you if that's what you want to do. It's my book, Money Partner Formula. It's exactly that, a formula to help you find your ideal money partners. So go ahead, grab a free copy, investorattractionbook.com, or click on the link in the description below. And this will walk you through in a very simple process, very simple methodology, an excellent formula on how you can attract your best investors, your best joint venture partners sooner rather than later. Grab a copy today.